Assume that you are working in a brand store, and during January 19, your customer placed orders with you, and the value of these invoices was $100,000. So these are the value of the invoices for your customers during January 19. And as per the company policy, they are giving your customers on their value of the invoices at 1% as a point. So in this value, which is $100,000, so as per 1%, so they are entitled to how many points? They are entitled to 10,000 points. This is the points earned. And as per the company policy, also the 1 point equal $1. So how much is the value of these 10,000 points? It will be $10,000. This is the value of the points. So the customers are allowed to utilize these points in the future as a discount on their future purchases or as a free products as well. According also to the company that they has estimated from the historical data from the previous years and the statistical analysis estimated that 95% of the points will be redeemed during the allowed period for that redemption. So 95%, this is the estimate about the redemption rate. So for example, for these 10,000 points that the customer already received on their purchases during this month, so they are estimated to redeem how many points? They are estimated to redeem 9,500 points as per the rate that the company determined, which is 95%. Now the question here is, how much revenue should the company recognize in January 19? Okay, so as per the question, this is a revenue, so it's under IFRS 15. So let's apply the model of the revenue recognition. It's a 5 steps model. Let's apply it. Step number 1. Do we have a contract? The answer is yes, we have a contract. It's between the company and the customer. The company is going to deliver the product to the customer and also is going to give the customer points to be used in the future. And the customer is going to pay today $100,000 and the customer already paid. So the rights for each party is clearly determined and stated in the contract. And the collection already done. So no doubt about the collection. So the collection is already there. So this is step number 1. All of the conditions of the contract, collectability, the rights, and the contract is clearly identified. All of the conditions are clearly identified in this step. So step number 1 is done. So let's go to step number 2. Step number 2 is talking about the performance obligations. So how many performance obligations we have in this contract? Let's analyze the contract again. The company is obliged to perform 2 things. Number 1 is to deliver the product to the customer, and this is already done today. And number 2 is to give the customer points that will be used and utilized and redeemed in the future. So how many performance obligations here? Are 2 performance obligations. There are 2 performance obligations. Number 1 is the product that the customer is going to provide and already provided, and the points as well. Okay, so these are the 2 performance obligations. Number 3, how much is the contract price? The contract price is $100,000. So these are the value of the contract, $100,000. So this is step number 3. Step number 4, we need to allocate the contract price, which is $100,000, over the performance obligations that we determined in step number 2 here, which are 2 performance obligations. So we need to allocate the $100,000 over these 2 performance obligations. The allocation base, as per IFRS 15, it should be the standalone selling price. But if the company cannot determine the standalone selling price, there are other methods that the company use. But let's assess firstly, are we able to allocate this transaction price over the performance obligation based on the standalone selling price or not? What is the standalone selling price? Standalone selling price means that if the company is going to sell the product alone, how much is the value of this product that is going to be sold to the other customers? So as per the question here, this consideration, which is $100,000, exactly equal the standalone selling price of this product. So the standalone selling price of the product is clearly identified, which is $100,000. So this is the standalone selling price of the first performance obligation, which is the product itself. Now let's go to the points, which is the second performance obligation here. Can we determine the value of these points? Definitely yes. How much points already earned? The customer earned on this purchase transaction 10,000 points. And how much is the value of these points? It is $10,000. But how much is the redemption rate that's expected from the customers? The customers are estimated to redeem 95% of their points. So the redemption of these points, the value will be 9,500 as per the rate that the company estimated here. So it will be $9,500 because each point equal $1. So the total here will be 109,500. This will be the total value of the performance obligations, of the standalone selling price of the performance obligations. So now we need to allocate what? The $100,000, which is the transaction price. So we need to allocate the 100,000 units. So we need to allocate the $100,000 over performance obligation number 1 and number 2. Based on what? Based on the standalone selling price here. So a pro rata of this allocation based on a pro rata basis, this will yield to revenue or amount to be allocated on the first performance obligation here. How much? It will be 91324. This is the amount of the transaction price allocated on the first performance obligation. And for the second performance obligation, the value will be 8676. So this will be the value of the price allocated to the second performance obligation here. Simply, how did we allocate? It is 100,000, for example, for the first one, divided by the total, which is 109,500 times the 100,000 here, equal 91,324. This is the value allocated in the first performance obligation. So step number 5 is saying that let's recognize revenue. Revenue in step number 5 is recognized once the company transfers the control on the performance obligation to the customer. So let's return back. How many performance obligations we have? We have the product. We have 2, the product and the point. On January 19 here, the company delivered the product. So the company gave the control or transferred the control of the product to the customer. So already the company delivered and they performed the first performance obligation. So the company in this month should recognize revenue equal to the amount that you allocated for the first performance obligation, which is 91,324. This will be the value of the revenue for the first performance obligation. So we are going to say the revenue from the goods on the Jan 19 here, it will be 91,324. This will be the value of the revenue allocated in the first performance obligation. Okay. The question here is, how much cash did you receive in January 19? I received cash $100,000. But how much revenue you recognized on January 19 on the same day of the transaction? I recognized revenue 91,324. Oh, you have a difference between the cash that you received and the revenue that you recognized for the first performance obligation on the same day, which means that you received cash for something that you didn't deliver yet, for something that you didn't perform yet. This means that you have a liability. This will be a contract liability on the same day of the transaction. Why? Because I received cash for something that I didn't deliver and I didn't perform. How much is this contract liability on the first day of the transaction? It will be the value of your points that you determined here, which is 8676. So I'm going to say here 8676. So the entry, if you would like to see the entry will be debit, cash, credit, revenue, and the credit also the contract liability. So cash, it will be 100,000. Revenue, it will be 191,324, and the contract liability, it will be 8676. So this will be the entry that you have: debit, cash, credit, revenue, and the contract liability. Okay, for the second date here on December 19, end of the year, end of 19, the company discovered that the customer redeemed points already. How much points the customer redeemed? 4,500. Okay. So when the customer redeemed the points, so the company performed part of its obligation. And the company gave a discount equal to the points redeemed. Okay, now let's realize what's happened. We estimated the total value of the points of the revenue related to these points, 8,676. So total revenue for the points equal 8676. In December 19 or in 2019, the customer redeemed 4,500. So we need to determine the value of this part. So simply you are going to divide 4,500 by the total point that you estimated, which is 9,500, and you need to multiply this by the total value of the points, which is 8676. This will equal revenue against the redeemed points in the same year. How much is it? It will be 4110. This will be the value of the point that you redeemed in this year. And the cumulative revenue from the redeemed points will be the same amount because the customer didn't redeem anything else. The question here is, how much contract liability you recognized in the first day? 8,676. And how much revenue you recognized and you performed, the partial delivery of your performance, how much is it? 4,110. So still the balance in the contract liability will be the difference, 8,676 minus 4,110. So the remaining contract liability will be what? It will be 4,566. So this will be the balance of the contract liability at end of the first year. Okay, let's continue. In the second year, 2020, assume that end of the year, you discover that the customer redeemed additional 4,000 points. But you have another new information here, that the company adjusted the estimate of the 95%, which is equal to 9,500 to 9,700 here. So again, the company adjusted the estimate. Originally, the company estimated that the customer are going to redeem 9,500. Now, in 2020, the company estimated that the customer are going to redeem 9,700. So what's happened here? You have a change in the estimate. And this change in the estimate is accounted under IAS number 8, change in accounting policies, change in estimates, and the correction of prior period errors. So the change here from 9,500 to 9,700, it is not a correction of prior period error. It's a change in estimate. And as per IAS number 8, the change in the estimate should be accounted in the current period and prospectively in the future as well. So you need to consider this change in the estimate in 2020. Don't go back to adjust what you have recorded before because you used 9,500 in your calculation. Don't go back and adjust all of your calculations because actually it is not error. It is not an error. It is an estimate and there is a change in the estimate. Okay, so we need to start here. In 2020, what's happened? There is a 4,000 points already redeemed. And the estimate changed from 9,500 to 9,700 points total to be redeemed, total points to be redeemed by your customer. Now, let's start calculating the revenue that you need to recognize in 2020 related to your points. In order to calculate this, let me ask you a question. How much total cumulative points redeemed? Actually, it is 4,500 plus 4,000 equal 8,500. And how much the total that you estimated so far? It is 9,700. So this percentage, the rate here, 8,500 divided by 9,700 equal the percentage of your cumulative points that has been redeemed. Okay, so 9,500 divided by 9,700, this will be give the rate of the cumulative points to be redeemed times the value that you have determined originally, which is how much? 8676. This is the value of your points. So I am going to use it and multiply 8676. This should give me total $7,603. This is the cumulative revenue of the points that I have redeemed so far as a customer. So if in the first year you recognized, the first year you recognize 4110, okay, and the total here is 7603. So how much the recognition of the second year. So simply this total, which is 7603 minus 4110, this is the first year 2019 value recognition, which we have recognized here, if you remember this value. So this will give me recognition for 2020. How much it will be? 3493 revenue for this year as a dollar. So I'm going to say, okay, in this year we are going to recognize 3493, and the total will be 7603 that I have calculated here. So this will be the total cumulative revenue that I have recognized. Okay, let's go to the last point. Remember, in the end of the first year, your contract liability was 4,566. Now you recognize 3493 out of this value. So the remaining will be 4566 minus 3493, which is the revenue here. So this is the contract liability and this is the revenue of the second year. This will end up to 1073. This will be the contract liability as a balance at end of the second year, which is 2020. So it will be 1073. This will be the balance of the contract liability. Okay, so now let's record the entries. In the first year, in the second year here, what happened? In the second year, you recognized revenue. How much revenue? The revenue that you recognize, 4110. So you are going to say 4110. And the debit is the reduction of your current liability, which is the contract liability here. So this will be the reduction on the contract liability. So it will be the same value in the contract liability. And the same entry will be in the second year. To conclude this case, the company is giving points as a loyalty as part of the loyalty program for its customers. So in the first day of the transaction, the company gave 10,000 points to the customers. And in the same day also, the company estimated that 95% of these points will be redeemed. So we are going to allocate part of the contract price to these points. The value that we have allocated to these points equal 9676. This is the value that we allocated. Then, because the company didn't perform its performance obligation regarding these points in the first day of the transaction, we recorded this as a contract liability. So we will find it here as a contract liability. Then, at the end of the first year, the customer started to recognize or started to redeem some of these points. How much points already recognized, already redeemed? It's 4,500 points. And how much is the total points that the company estimated to redeem? 9,500. So you are going to make a pro rata allocation by the value of the revenue allocated for these points. So this equal to the revenue of the first year, which is 4110. In the second year, the customer redeemed additional 4,000 units. So the total points so far, it will be 4,500 and 4,000 equal total 8,500. This will be the total points allocated, redeemed by the customer. If you would like to calculate the percentage as a cumulative redemption, so you are going to divide by the 9,700, which is the total estimated or re-estimated or adjusted estimated points to be redeemed by the customer. So 8,500 divided by 9,700 equal a percentage of the cumulative revenue. This percentage you need to multiply by the total revenue allocated to the points. So the total revenue so far at end of the second year as a cumulative revenue for the points, it will be 7603. So 7603, so this will be the cumulative revenue. How much you recognize revenue in the first year? 4110. So you are going to recognize revenue in the second year, 3493. And don't forget that your contract liability will be adjusted by this and reduced to 1073. This will be the ending balance of your contract liability.